Chapter 23, ESOP Stock Bonus Plans. What is it? A stock bonus plan is a qualified employer plan similar to a profit-sharing plan, except that accounts are invested in employer stock. An ESOP is a stock bonus plan that the employer can use as a conduit for borrowing money from a bank to buy employer stock. Unique ESOP features: there's a leveraged loan and prohibited transaction exemption, the deferral of gain when selling stock to ESOP and buying securities, and deduction for dividends paid to ESOP for distribution or loan payments. Unique ESOP features: requirement of funding primarily with the employer securities and diversification requirement. When is it used? When an employer wants to provide a tax-advantaged way for employees to acquire company stock. When shareholders would benefit from the additional market for company stock. When an employer wants to leverage and generate capital through tax-exempt loans. When an employer wants to broaden its ownership. When the business is a corporation. The advantages: employees receive an ownership interest in the employer company, providing performance incentive. A market is created for the employer stock, increasing liquidity for existing shareholders. And employees are not taxed until the shares are distributed. The employer receives a deduction for the contribution of cash or shares of stock. Overall cost of corporate borrowing can be reduced, and shareholders can obtain tax benefits by selling the stock to the plan. Because the plan is qualified, all the qualified plan requirements apply. Issuing shares of stock to employees dilutes the stock of existing shareholders and their control of the company. Company stock may be a very speculative investment. Design features: participants' accounts are stated in terms of shares of company stock. Benefits generally distributed in the form of cash rather than shares of company stock. And dividends can be used to increase participants' accounts or can be paid in cash. Plan allocation formulas may not discriminate in favor of highly compensated employees. Plan participants must be given certain voting rights depending on whether the stock is publicly traded or not. Plan not required to provide spousal death benefits. Diversification provisions: participants can reinvest elective deferral or employee contribution accounts invested in employer securities. Participants with 3 years of service can reinvest their employer contribution accounts. There are put options and age 55 diversification. ESOP loans: a leveraging feature enables employer company to borrow money on a favorable basis. The procedure: the ESOP trustee borrows money from a lending institution. Trustee uses the money to buy stock from the company. The employer makes tax-deductible contributions to the ESOP so the trustee can pay off the loan from the lending institution. ERISA and other regulatory requirements: there is ERISA requirements of eligibility, vesting, and funding. The IRS requirements: there's diversification, not all ESOPs, put option, pass-through voting, not profit-sharing plans, tax deferral for unrealized appreciation on company stock distributed from the plan in a lump sum distribution. Directors and policymaking officers with ESOP or stock bonus accounts may be subject to insider trading restrictions under federal securities laws. Tax implications for employees: the annual addition to participants' accounts cannot exceed the lesser of 100% of a participant's compensation, or $53,000 in 2015. However, in 2019 is $56,000. Plus the additional $6,000 additional age 50 limit. It is tax deferred on the employer contributions. Tax deferred on unrealized appreciation of stock received in a lump sum distribution. There are 10-year averaging tax treatment for certain employees. and the purchase of replacement securities has special tax rules. For employers, the employer contribution deductible when made, up to the annual limit. Within limits, a C corporation can deduct dividends paid on stock acquired with an ESOP loan if dividends are paid in cash to plan participants or beneficiaries, paid to the plan and distributed within 90 days to plan participants or beneficiaries, payable at the election of participants or beneficiaries, made payments on loans used to acquire employer stock, non-forfeitable. Used in estate planning, as a potential buyer for stock, it can be valuable in planning the estate of a shareholder of a closely held business. Typical scenarios would be purchase of stock at death, business continuation planning opportunities in a buy-sell agreement, or a source of cash. Use of an ESOP or stock bonus plan as the purchaser avoids some problems. Corporation gets a deduction for contributed amounts. Plan is a tax-exempt entity, so funds accumulate on a before-tax basis. The plan is not limited, subject to accumulated earnings tax or the ultimate minimum tax. Life insurance held in ESOP will not increase corporate value for purposes of federal state tax and can apply to the IRS for a ruling that a transaction is not a dividend. Business continuation, use of an ESOP or a stock bonus plan can help solve business continuation problems related to estate planning issues. Buy-sell agreements. ESOP or stock bonus plan can carry out a corporate buy-sell agreement among shareholders. Participant investment direction or earmarking is permitted under ERISA. Participant is given the right to direct the trustee to invest his or her plan account in specified property. Sources of cash. Establish the ESOP or stock bonus plan to turn shares into cash as needed in a lifetime sale. And lower tax rates generally apply to most long-term capital gains and dividends. How to install the plan. Follow the required plan installation procedure, and a registration statement may have to be filed with federal or state securities regulatory agencies.